For more than a generation, Americans have heard a steady drumbeat of financial advice. Contribute as much as possible to your 401k, fund your IRA, take full advantage of employer matches, and let compound growth do the rest. For millions of households, that guidance has been sound. Tax-deferred retirement accounts remain among the most powerful long-term savings vehicles available. But for high earners and disciplined savers who have accumulated substantial balances, a less discussed reality is emerging. Large concentrations of wealth inside traditional qualified retirement plans can create a significant tax burden for heirs. The issue is not oversaving or poor investment decisions. It is the way these accounts are treated under tax law at death, and how that treatment differs from other assets in an estate. The result can be a quiet erosion of family wealth, even after decades of careful planning. Many families view their estate as a single pool of assets. A brokerage account, a home, business interests, retirement plans, all of it is often considered part of the same financial picture. From a tax perspective, however, those assets are not treated equally. Taxable investment accounts, real estate and closely held businesses generally receive a step-up in cost basis at death. If an investor purchased stock decades ago for $100,000 and it is worth $500,000 at death, heirs typically inherit it at the $500,000 value. The embedded capital gain effectively disappears. If the asset is sold shortly after inheritance, little or no capital gains tax may be owed. Traditional IRAs, 401ks and other qualified retirement plans operate differently. They do not receive a step-up in basis. Every pre-tax dollar inside those accounts remains fully taxable as ordinary income when withdrawn, even after the original owner has died. That distinction makes qualified retirement plans among the most tax-sensitive assets in an estate. While other assets may shed built-in capital gains at death, retirement accounts carry their deferred tax liability forward to beneficiaries. For larger estates, the problem can become more pronounced because qualified retirement accounts may be exposed to two layers of tax. First, the account is included in the owner's taxable estate. If the estate exceeds federal or applicable state exemption thresholds, estate tax may apply to the account's full value. Second, when beneficiaries withdraw funds from the inherited retirement account, they pay ordinary income tax on those distributions. Most assets are typically exposed to one tax layer or the other. Retirement accounts can face both. Consider a simplified example. An individual dies with a $3 million traditional IRA. The IRA is included in the taxable estate. If estate taxes apply, they are calculated on the account's value. Later, when heirs withdraw funds from the inherited IRA, they pay income tax at their marginal rate. By the time both taxes are accounted for, the net amount received by beneficiaries can be substantially lower than the account balance suggests. Years of disciplined saving and compound growth may translate into far less after-tax wealth than anticipated. Several long-term trends have amplified this issue. Americans are living longer, allowing retirement accounts to compound for decades. Contribution limits have increased steadily, and employer matches in corporate retirement plans can significantly boost balances. Strong long-term equity market performance has further accelerated growth. At the same time, legislative changes have shortened distribution timelines for many inherited retirement accounts. Non-spouse beneficiaries are often required to distribute inherited accounts within a defined period rather than stretching distributions over their lifetime. This acceleration can compress taxable income into fewer years. The result is that retirement accounts are frequently among the largest assets in an estate. In some cases, they exceed the value of real estate holdings or taxable brokerage portfolios. Ironically, they are often the least tax-efficient assets to transfer at death. Many parents assume their children will manage inherited retirement assets carefully, spreading withdrawals over time and minimizing tax impact. That assumption often overlooks practical realities. Heirs frequently inherit during their peak earning years. They may already be in high marginal tax brackets. Mandatory distribution rules can require significant withdrawals within relatively short windows, pushing total income even higher. Large inherited IRA distributions can move beneficiaries into top tax brackets, reduce eligibility for certain deductions or credits, and trigger additional state tax liabilities. Instead of compounding quietly for decades, the account may be systematically drawn down under a compressed schedule. Without advanced planning, families lose control over when taxes are paid, how much of the account ultimately goes to the government, and how efficiently wealth transfers across generations. The size of a retirement account is only part of the story. The after-tax value to heirs is what ultimately matters. Qualified retirement accounts remain powerful accumulation tools. For many individuals, maximizing contributions is still prudent. The issue is not whether to use these accounts, but how to plan for the tax cost they create at death. Effective planning requires shifting focus from the account balance to the net amount beneficiaries are likely to receive. That means modeling potential estate tax exposure, projecting income tax consequences for heirs, and evaluating strategies that can mitigate or offset those costs. Some households consider gradual Roth conversions during lower income years, paying tax today in exchange for tax-free withdrawals later. Others manage distributions strategically in retirement to prevent accounts from growing beyond what is necessary to support lifestyle needs. Diversifying assets across taxable, tax-deferred, and tax-free buckets can also improve long-term flexibility. By not concentrating too much wealth in any one tax category, families reduce the risk that a single asset class undermines the efficiency of the entire estate plan. Among the tools often discussed in this context is life insurance. Life insurance occupies a distinct role in estate planning because death benefit proceeds are generally income tax-free. When structured properly, they can also be kept outside of the taxable estate. Rather than attempting to eliminate retirement account taxes altogether, which is often unrealistic, some families use life insurance as a wealth replacement strategy. The concept is straightforward. Calculate the projected tax liability associated with large qualified plans and design a life insurance policy intended to offset that anticipated loss. In practical terms, this can mean using life insurance proceeds to provide heirs with tax-free liquidity while retirement assets are taxed. It can help ensure that beneficiaries receive a predictable inheritance even as they navigate required distributions from inherited accounts. This approach reframes life insurance from a simple protection product into a strategic planning tool. Instead of focusing solely on income replacement during working years, it becomes a method of restoring after-tax value to an estate. When coordinated carefully, it can also provide liquidity to pay estate taxes without forcing the sale of illiquid assets such as businesses or real estate at inopportune times. For decades, the financial conversation has centered on maximizing contributions and growing retirement balances. That advice remains relevant for many Americans who need to build sufficient savings for their own retirement security. For others, particularly high earners with substantial existing balances, the conversation may need to evolve. The question is no longer simply how large a retirement account can grow. It is how that account fits within the broader tax landscape of an estate. Qualified retirement plans are not neutral assets. They carry embedded tax liabilities that behave differently from other holdings at death. Ignoring that distinction can lead to unintended consequences for heirs. Families who recognize the issue and plan proactively are better positioned to preserve wealth across generations. By focusing on after-tax outcomes, modeling potential liabilities, and coordinating strategies across tax categories, they can reduce the risk that a lifetime of savings is diminished by avoidable inefficiencies. When retirement accounts become a family's largest asset, planning for their tax impact is not optional. It is essential to ensuring that long-term financial discipline translates into a durable, efficient legacy.